Genevieve, and I'm Brandon King. I'm the chair of the Young Lawyers Forum committee for this section, which our committee is the one who sponsors this competition. And I will just echo congratulations to you both to making it through to the LL.M final round. So we know that it's a challenging competition. We always have challenging problems. So give yourselves a pat on the back for making it here today. And with that, I'm going to turn it over to Bill Alexander, who's going to kick it off for the judges. Over to you, Bill.
Hi there, I'm Bill Alexander. In real life, I'm with Skadden Arps in Washington, D.C. And during this exercise, I am going to be playing the role of the senior partner in your firm. I'm going to ask the other two judges to introduce themselves, and then we'll turn it over to you, and the clock will start, and it's your presentation to give. Why don't we start with Rochelle?
Hi, my name's Rochelle Hodis, and as Bill said, in real life, I think he meant in real life, like not playing this rather than in real life, not on virtual, but I'll give him the benefit of the doubt. I'm a partner with Crow LLP, and I'm going to be playing the part of the client owner.
And that leaves me. I'm John Moriarty. In real life, I'm retired. Up until about 6 weeks ago, I was a senior executive in the Office of Chief Counsel of the IRS. I headed the income tax and accounting office there. And I will be playing the role of the tax director of the client today. So with that, rather than take up your time, please go ahead and start.
Hi, so my name is Melia, and this is my partner, Adnan, and it is nice to meet all of you regarding your tax issues. I will now turn it over to Adnan to tackle the first issue. So Adnan.
Hi, as Melia introduced me, my name is Adnan, and I am here to talk to you first regarding the ZST acquisition. And I believe you had asked us to look into the fact that Daintree needs it to be a stock acquisition, principally for non-tax reasons related to their labor union contracts, while the seller, Zstream, wants it to be a asset acquisition. They insisted on it. And we believe they insisted on it to be an asset acquisition because they will pay lower taxes. If I may just share the screen quickly. Here we go. Basically, the bottom line is that they're going to have about $400 million of gains if it is an asset sale. However, if it's a stock sale, they'll have about $700 million of gains, which is basically $300 million more. So that's why they are insisting on an asset sale. We don't have enough information to be able to parse as to what part of the gain on an asset sale would be ordinary income versus capital gains, whereas for the stock sale, the whole thing would probably be, it would be a capital gain. And we don't have that information, but the bottom line is that they're trying to save about, or they're trying to realize about $300 million less in gains. Now, to help them achieve that, as well as our client, your objective, Ms. Dezos, what we are recommending is a stock acquisition of ZST, plus a joint election by Zstream and Daintree under IRC 338H10. What this will do is that it's going to lead to an asset acquisition for income tax purposes, which is going to make Zstream happy. And it'll be a stock acquisition for every other purpose, which is what you're looking for. Before we go into more details, I'd just like to point out that taking this election does not really have any negative impact for Daintree, whereas it helps Zstream pay lower taxes. And if we go to the next handout slide, which is on the screen share now, we quickly summarize IRC 338 to H10. It's a bit messy, but it's not that problematic. Basically, the top part of the slide in gray tells us that you've got a stock acquisition for everything other than income tax purpose. So it's a regular stock acquisition. You pay 800 million for 100% of ZST stock. ZST, instead of being part of Zstream, goes to Daintree. The legal entity, ZST Technology, survives, which I believe is what you're looking for. And the interesting part is when you take this election, the gain on the stock sale is totally ignored for tax purposes. Now, what happens for tax purposes? Well, we go to the blue section, and there we see that the deemed asset acquisition transactions for income tax, these are deemed transactions. They're not the actual transaction that happened, but it's sort of like a make-believe world for taxes where it's going to be deemed that these transactions really did happen and income taxes are going to be levied based on it. So what happens is that you've got ZST here. It starts being called old target. And Daintree, or rather a fictitious entity that just magically appears called new target, on the day of the acquisition, will be deemed to buy all the assets of old target for, in this case, 900 million, which is the 800 million you're paying for the stock, plus the $100 million of non-recourse debt that you're assuming. So that's sort of like the gross proceeds if you were doing an IRC 1000, basically a capital gains analysis. You're paying that and you're getting all the assets. Now, when ZST, which is now called old target, gets all that money, they are deemed on that same day, the day of the acquisition closes, before the end of that day, to distribute all the proceeds to their parent. In this case, looking at the org chart, basically they're going to give all the money to Zstream's consolidated group. This distribution is a tax-free distribution under IRC 332 in this case. And what happens is that the distribution is tax-free, but there's still taxes. And the taxes will be on the deemed asset sale. So basically, old target will be deemed to have realized gains. And as we mentioned in the previous slide, you've got this $900 million coming in. And we took a look at the balance sheet. Looking at the balance sheet, there were about $500 million. $500 million of adjusted basis for those assets. So you'll have a gain based on the difference between that 400 million, which in this case will be taxable to the consolidated group that ZST was part of on the day of the sale. And in here, it's deemed that it's still part of Zstream's consolidated group. So Zstream gets the tax liability, not Daintree. That said, you do want to get indemnification for all tax liabilities and all other liabilities like you would do for a stock acquisition, because legally you are actually still buying ZST Technologies and all its liabilities. And incidentally, New Target, even though it's considered to be a totally unrelated entity for this, it is stuck with all the old liabilities of old Target. So if Zstream goes bankrupt or something, you're going to be stuck with the liability on the sale of the asset, as well as all the other tax liabilities Zstream has, while ZST Technologies was part of the consolidated group. So you do want that. And if you're worried that Zstream is going to go bankrupt, there's no point in getting indemnification if the company disappears. What you want to do is you want to consider an escrow account or purchasing insurance or something else, or just doing credit analysis to the point where you're comfortable that they're going to be around. Now, that New Target has all the assets. Daintree owns New Target, and you're going to get a step up in basis because it's an acquired, all the assets are now acquired as if it was an asset acquisition. And if we go to the next slide, this is really the reason. Usually it's the acquirer, not the seller, who wants this kind of a 338 election or an asset acquisition transaction, because all of a sudden you will have higher depreciation and amortization deductions because first, the basis of ZST's assets, which in a stock acquisition would be unchanged at the 500 million, gets stepped up, and you end up with 900 million, which is a fair value in this case. It'll get stepped up to that amount. Then the self-created intangibles that ZST have, they're not amortizable under Section 197. Voila, here it's a purchased intangible and it's amortizable over 15 years straight line. And the reason we know here it is because we took a quick look at what's in this, and it seems to be its patents, copyrights, trademarks, and the value of employee contracts, and all of these are 197 intangibles that are amortizable. Now, if you've done a stock acquisition, you would have no bonus depreciation. Here you have bonus depreciation because these are purchased assets. And you get 100% bonus depreciation for all qualified assets if you close the transaction in 2022. Unfortunately, looking at the balance sheet, it seems like they only have about 20 million of equipment that'll be qualified. So it's a good transaction for us as well as for them. Are there any questions at this point?
You mentioned asking for indemnification against tax liabilities. Would that increase the amount of liabilities being assumed in the transaction?
No, we would want them. Daintree would want Zstream to indemnify their tax liabilities, because the problem is that for the years where ZST was part of the Zstream consolidated group, there's joint and several tax liability, and that tax liability survives this transaction. So new target would inherit that joint and several tax liability. So in this transaction, even though it's structured that the gain on the asset sale or the deemed asset sale will be, the tax on it will be paid by the seller. If the seller doesn't pay it or the seller goes bankrupt, this is a sort of backdoor way that it comes and bites you. And we'd want indemnification for that. And I believe in the term sheets, I think one of the client's employees mentioned that they are going to indemnify you for all tax liabilities, but you still want to make sure, and then you want to consider insurance or something in case they go bankrupt and can't pay. The IRS will come for us. So that's it.
Thank you very much.
Please.
How am I going to make that election?
It's a joint election. I cannot remember the exact form number, but you both jointly make that. And it has to be made within the 15th day of the 9th month following the month of the transaction. And the buyer and the seller both jointly make it. I mean, here it's good for you, it's good for them. They get to save money on taxes, and you get higher depreciation and amortization expenses going forward that'll save on your tax bill. So there's no issue of trying to convince them to do it. It's in both parties' interests.
Thank you. I noticed that the target is based in California. Do you get the same treatment under California for California taxes?
I believe so. There's a California Revenue and Tax Code provision, section 24451, that incorporates the federal tax code chapters like 301 to 386. So that'll be included. And also I believe there was a specific section in that particular California's tax code 23806, where they actually said that this kind of federal election is binding in California. So yes, you will, I mean, California will also do this.
Thank you.
If there aren't any other questions, can I pass it on to Melia for the sake of timeliness? Please, Melia.
Yes, so thank you, Adnan. That was a great job. So after reviewing the case file and the employee roster, we have found a few SALT nexus issues which refer to the state and local taxing of a jurisdiction such as California and another entity. And based off of the relevant state law and associated state guidance that's been recently issued on the topic, there are 3 issues, and I have a slide, if you give me a second to share. Okay, so as you can see here, we have the pre-pandemic operation states as well as the telecommuter states, which we've added on. And SALT Nexus has been created in each of those states. For Colorado, it's due to payroll being over $50,000. And for Florida, Georgia, Nevada, and Texas, it is due to employees working there remotely. So the employees who are working there remotely do also establish a SALT Nexus in addition to the employees working in person. Now stop sharing for a second. Yeah, so to limit the risk, our client should file the SALT return extensions in the above mentioned states. And as well as that, there are also the other two issues. Establishing the SALT nexus with the additional states may be advantageous for the accounting of income, for the income tax rate differentials, as well as the decrease in the state tax liability in other states. So for instance, Washington does not have the income tax requirement, but California's and Massachusetts and New York all have a higher one, whereas Colorado, Florida, and Georgia are all under 6%. And the income that was previously taxed in those higher tax states may now be taxed in lower tax states. And to calculate this, we can use the formulary apportionment rules on either the 1-factor or the 3-factor. Massachusetts and Florida both use the 3-factor. However, all the other states use the 1-factor, which focuses just on the group sales. So additionally, there are also some income tax implications due to the potential state withholding issues, and I will show that slide. 1 second. So as you can see in this slide, the employee income taxes are withheld for the additional states. For New York, which is the strictest, the withholding is based on where the office is located. However, for California and Massachusetts, it is still where the work is performed. And for the telecommuting states of Colorado and Georgia, it is based on where the employees are performing the work. So I'll stop sharing. So for the state guide, so for the state withholding implications, there's also state guidance on the exceptions to withholding rules, and they have either expired or were not originally issued. In states like New York, it's still in place, whereas in Massachusetts, it is currently pending regarding the telecommuter tax withholdings. Once Georgia did have an order, but that expired in 2021, as well as Massachusetts, which expired in September of 2021. And are there any questions on that?
I'll ask you one. So how is California going to feel about these telecommuters who used to live in California now being in other states? Are they going to be, is California going to be okay with like not withholding on them?
Yeah, so if some of the other states aren't receiving any taxes due to the lower withholdings, we can reapportion it. So all the taxes will be paid to California, and then California will then pass those taxes out through to the other states.
Oh, sorry, can I just clarify? From the senior partner's question, were you talking about income taxes or withholding taxes in this?
I'm talking about withholding taxes.
Okay, sorry. The California rule basically is that you withhold, or an employee has to pay taxes in the state they're working. So if you're not working in California, you don't pay taxes in California. And
but I'm located in California, right?
Yes, you are, and you will be taxed by the state of California.
And as far as the state knows, all my people, I mean, these guys are remote. Is there a chance that California is going to say, yeah, they may be during the pandemic in wherever they might be, but, you know, we want our taxes for the work that they, you know, our employment taxes. Here in California, we have, you know, budget shortfalls, and we need those taxes. Is that going to be something that could happen?
Melia, do you want to take that?
Oh, sorry. Yeah, so with the apportionment factors, as mentioned, when all of so if other states are supposed to be owed taxes, they will all go through California and then be reapportioned.
I don't know what that means about go through California. I just don't understand.
No, let me try to clarify this. Basically, you're saying that the employees have moved out. Like, let's say I was based in California, and then I moved to lower tax Nevada. California is not going to be happy, but if I'm working in Nevada, I pay Nevada taxes, even if my office was in California. And the pre-pandemic guidance is long over. And even during the pandemic, California reiterated its rule that it's based on where the work gets performed. It's New York that said that, hey, even if you've moved out, if your office is in New York, you pay us.
I thought I had read that in the news. Thank you. That was helpful.
So I think that's the distinction. I think we're just slightly confused whether you were talking about corporate income taxes or your personal income tax. Sorry about that.
I'm talking about my employees. Sorry.
Yeah, sorry about that. It was just slightly.
Thank you.
Is there anything we should think about doing going forward to minimize the likelihood that we'll have double tax?
For employees?
For employees on the withholding.
It's only New York that has that rule that's unfortunately a little annoying. It's a convenience of the employer rule. And there you might get double taxed. And what happens is that if your office is in New York, and let's say you move to New Jersey isn't lower tax, let's figure Pennsylvania or some other state that's lower tax close by, you still have to pay New York taxes. If your operations are in New York City, which we're not totally sure about, then you have to pay city taxes no, you don't have to pay city taxes. They got rid of the commuter tax, sorry, in New York City. But you have to pay New York state taxes. And they don't care if you've moved to another place for the last 3 months, 6 months, unless unless your employer opens an office in the other place, or your move was because of the convenience of the employer rather than, for your comfort. You have to pay New York. Typically, most other states give you a credit for taxes paid to another state, like New Jersey, which is the most common one, and they've been complaining about New York's rule. They actually do give you a credit for taxes paid to New York. So that's how you'd avoid it. But if your state doesn't give you the credit, I'm sorry, you're out of luck.
Thanks.
Thank you for that. If there are no more questions on that, we will go into the third issue.
I am back with the third issue, and the third issue is our Canadian friends, and the fact that the CRA, the Canada Revenue Agency, might be reassessing the transfer pricing. And it's quite correct to be worried about being double taxed. And to avoid being double taxed, what we're recommending is that you initiate the competent authority process. And basically, this is a product of the US-Canada tax treaty. It tries to avoid double taxation on exactly things like this, where the transfer pricing rates have been adjusted by one party or the other. And you should appeal to both competent authorities, and they either work together or unilaterally to try to resolve this issue so that you're not double taxed. The interesting part about this treaty is that they don't guarantee to eliminate double tax, they just are committed to trying to resolve it. However, Article 26 of this tax treaty, the mutual agreement procedure, does have a provision allowing for binding arbitration, but it is optional, and Daintree as well as the competent authorities have to agree. And if you do this, what happens is that the two parties get into a tug of war. They both want more income allocated to their side, and hopefully they'll agree to something that we like. And we were specifically tasked with telling you what the next steps were. And the next slide lays out the next steps. Excuse me. One is to provide notice to both competent authorities. This helps avoid issues regarding statute of limitations. The next step after that is to seek a pre-filing conference with the US competent authority. Now, it's not mandatory for this type of adjustment that's being done, but they recommend it for situations like this if the amount at stake over all the competent authority years exceeds $50 million US. We're not sure as to the dollar amount, but we thought that we should still consider that. Then once you actually receive the CRA's notice of assessment, within 90 days, you need to file an objection with their appeals branch. And this basically protects your right to appeal domestically in Canada in case this whole competent authority procedure doesn't work, or whether you want to argue against them domestically or take them to the tax court of Canada. The other thing you need to do in 30 days is pay half the assessed amount if Daintree's total taxable capital employed in Canada exceeds 10 million Canadian dollars, which is about $8 million US. Again, we didn't have that information, so we stuck it in. And the final process, when you finally have the notice of assessment and you've gone through it, is to file the competent authority requests in both countries. You need to do that in both countries, ideally. And you take it from there. Are there any questions on this issue? Great. In that case, I will pass this on to Melia to talk regarding Ms. Dezos's tax problem.
Thank you. So for the final issue, Ms. Devos, I will share my slides so that we can show you what our recommendations are. So part of the reason why you receive the Form 8986 is due to being a non-pass-through partner in a partnership in the 2018 year. And that partnership is also elected a push out, and that goes through to the partners, including yourself. So what you'll need to do is take the Form 8986 and take those adjustments into a pro forma tax return to calculate for the revised year's correction amount. And then once that is done, if it has been affected for the 2018 tax year, you will report all of that income on your 2021 tax return using the Form 8978. And if you have more questions on that, we do recommend speaking to the high net worth tax partner. Stop my share. So yeah, with all of that, we've addressed all the issues given to us, and thank you for your time. Oh, we can't hear you. Sorry.
I had a question. Why did I get this Form 8986?
Yeah, so the IRS went through and did an audit on the partnership's return for 2018 and found that the amounts that were listed there did need to be adjusted and more taxes were owed. And the partnership can either decide to pay those taxes or push them out to the partners. And the partnership elected to do the push out.
What year was that?
For 2018. So they can leave.
So do I amend my 2018 return?
So you'll be using the pro forma return, to do the 8986, and you'll be filing that with your 2021 taxes.
I don't know what a pro forma is.
Oh, so it's just a form online that you can download or get from a tax attorney or the high net worth tax partner.
Okay, thanks.
Thank you.